All right, let me say something that sounds dramatic, but unfortunately isn't. The most dangerous part of your retirement isn't year 25 or 30. It's actually the first 5 years, right at the beginning. Yeah, the beginning. The part where you finally sit back and think you made it after all those years of working and saving and stressing, which ironically is exactly where things quietly starts going wrong. And this isn't just some random opinion from a guy online trying to scare you. This actually comes from real data where thousands of retirement scenarios were tested, and the results are honestly a little uncomfortable. Nearly 70% of retirement plans that failed had one thing in common. They didn't collapse slowly over time. They got hit early, right at the start before the plan even had a chance to stabilize. Not later, not eventually. This didn't happen somewhere far down the line. It happened right at the start, almost immediately before anything had time to recover or adjust. Now let's slow this down because most people think retirement failure just means you spent too much money and ran out, which sounds logical, but that's actually not what was happening in most cases. In most cases, people were actually doing everything right. They weren't overspending or doing anything reckless. They were following a reasonable plan and still somehow things didn't work out the way they expected. They weren't out there buying luxury cars or gambling everything on risky bets. They were just following a normal balanced approach, which makes it even more uncomfortable because nothing obviously stupid was happening. Think about a pretty standard setup: a careful withdrawal plan adjusted over time, a long retirement horizon, and a balanced portfolio. Basically, everything that looks correct on paper. And still, somehow, it wasn't enough. And even with all of that in place, a meaningful number of these plans still didn't make it, which is where things start to feel confusing, because if everything looked right, then what exactly went wrong? The answer was surprisingly simple. It wasn't bad decisions or lack of discipline. It was just bad timing, which sounds harmless but turns out to be incredibly destructive. If your portfolio takes a hit early in retirement, the damage isn't the same as later, because you're withdrawing at the same time, which quietly makes the loss much harder to recover from. You're not just losing value on paper, you're actually pulling money out while things are down, which means you're locking in those losses, and the part you sold doesn't come back when things recover. So, even if the market recovers later, it doesn't fix the problem because now you're working with fewer assets, which means the recovery helps less and the gap never really closes again, which is basically like watching the party from outside after you already sold your ticket. So even though the music is back and everything looks great, you're no longer part of it. And this whole thing actually has a name. It sounds complicated, but it really isn't. It just means the order in which things happen matters more than the outcome itself.
Two people can experience the exact same overall returns, but if one starts with good years and the other starts with bad ones, their outcomes end up completely different, even though nothing else changed.
One person retires into a strong market and everything works out smoothly, while the other starts during a downturn and struggles immediately, even though both followed the exact same plan. Same returns, completely different outcomes just because of when things happened. Which is slightly uncomfortable because it means timing had more control over your retirement than you probably expected.
If you happen to start retirement during a strong market, your plan becomes surprisingly stable and things feel easy, but if you get hit early, you're suddenly in survival mode without really changing anything.
But if your portfolio manages to get through those first few years without major damage, something interesting starts to happen. Your situation becomes more stable and the same risks don't hit as hard anymore. A market drop later in retirement is usually just annoying, but that exact same drop early on can be far more damaging. Even though it's the same event, the timing completely changes the outcome. You can't control what the market does or when it moves, but you can control how your plan responds to it, which ends up making a much bigger difference than trying to predict anything. One of the simplest adjustments is being slightly less aggressive. It reduces how hard your portfolio gets hit early on, and in this phase, avoiding big losses matters more than chasing gains. Yes, you might miss some upside when things go well, but that's kind of the point. Because this stage isn't about maximizing returns, it's about making sure a bad start doesn't ruin everything. But if you adjust even slightly when things go down and take out a little less, you give your portfolio room to recover, which ends up making a much bigger difference than people expect. Another simple idea is to not depend on your risky assets right away, and instead use safer money early so your investments get time to recover before you actually need them. And there's another factor people seriously underestimate, not just inflation, but when it happens, because if your costs jump early, that higher level sticks around and quietly puts more pressure on your plan. And if that increase happens early, it's far more damaging because that higher cost stays with you for years, but if it happens much later, the impact is actually much smaller. The real worst case is when both happen together. Your portfolio is dropping while your expenses are rising, creating a situation very hard to recover from. Retirement success isn't about chasing the highest returns or making perfect decisions. It's about avoiding the kind of early damage that's hard to recover from. If you can make it through those first few years without major damage, the odds start shifting in your favor and things become much easier compared to what most people expect at the beginning. Most people imagine retirement as a smooth, predictable journey, but in reality, it's more like getting through a difficult first phase before things start to feel manageable later on. So if you get through those first few years, things start working in your favor. But if you mess that part up, even a solid plan can quietly fall apart later. And if this made you rethink how fragile this actually is, then you're already ahead of most people, and yeah, you know what to do. Because unlike your retirement plan, this actually rewards consistency. Which is why most people don't realize the biggest risk isn't at the end, it's right at the beginning, where everything still feels safe, and that's exactly where it quietly breaks. And that's where it gets a little unfair, because two people can do everything the same, follow the same plan, and still end up in completely different situations just because of how things started. Which is uncomfortable because it means a big part of your outcome isn't skill or discipline, it's just when you happen to start, which isn't exactly something people like to hear. Because retirement success isn't about getting the highest returns or picking the perfect investments or timing the market, it's really just about surviving those first few years without taking damage. If you get through that phase intact, the odds shift heavily in your favor and things start working out much more easily than most people expect. So the real question becomes, are you building something that only works when everything goes right, or something that can actually survive when things don't? Because those lead to very different outcomes. And if this made you rethink how fragile this actually is, then you're already ahead of most people, which is slightly ironic because most only realize this after it's too late. Shield pops. And yeah, if you found this useful, you know what to do, because unlike your retirement plan, this actually rewards consistency instead of punishing you for getting the timing wrong. Which means if you keep doing the same things consistently over time, the outcome actually improves instead of breaking apart, because consistency here works in your favor instead of against you. And that's why it keeps circling back to the same uncomfortable idea that everything depends on how those first few years go, because that's where the foundation either holds or starts breaking. So even though it feels like a long journey, most of the outcome is quietly decided right at the start, before anything has time to play out. Which is why that phase matters more than everything else. And once you see it this way, it's hard to unsee, because it shifts your focus away from chasing returns and toward protecting the part of the plan that actually determines whether it survives, which brings you back to the same place where it all starts, that moment where everything feels safe and stable, but is actually the most fragile part of the entire plan. And that's why the part where you finally feel like you made it is ironically the part you should be paying the most attention to, because that's exactly where things tend to go wrong. Most people plan for retirement like it's a smooth 30-year journey, but it's not. It's more like a difficult first phase and then things become easier later. It's more like a dangerous first level where most of the risk is concentrated right at the start, and once you get past that phase, things actually become much easier and more stable afterward. So if you manage to survive those first few years without taking major damage, the odds shift heavily in your favor, and the rest of the journey becomes much more stable than most people expect. But if that early phase goes wrong, even a well-structured plan can quietly fall apart later, because the damage from the beginning keeps compounding over time without giving you a real chance to recover. So in the end, it's not really about having the perfect plan or getting everything right. It's about whether your plan can survive that fragile beginning where most of the actual risk is concentrated. Which brings everything back to the beginning again, where it feels calm and stable on the surface, but underneath, that's exactly where the risk is highest and where things quietly starts to break. A practical way to handle this is keeping a portion of your portfolio in safer assets or cash, so you're not forced to sell investments during a downturn, which helps reduce long-term damage. Which also means your withdrawal strategy matters a lot more than people think, because taking a fixed amount regardless of market conditions increases the risk of depleting your portfolio early. But adjusting withdrawals slightly during downturns can significantly improve outcomes, because it gives your investments time to recover instead of locking in losses when prices are already low. So when you combine lower volatility, flexible withdrawals, and some safer assets, early on you're not trying to beat the market, you're just making sure your plan can survive long enough to benefit from it. And if this made you rethink how you structure your money, then just keep learning and stay consistent, because unlike the market, this actually rewards you over time. So yeah, Like, share, and subscribe if this helped.